Hi, welcome to the podcast series on the role of longevity annuities in different socioeconomic classes, a Canadian case study. I'm Johnny Lee, Professor of Actuarial Science at the University of Waterloo. This podcast series has 3 podcasts. In podcast 1, I will give you an introduction to longevity annuities. Before I begin, I would like to give you a background about this research project. Well, first, it is quite well known that one solution to retirement income security is life annuities. Economists generally agree that, number one, life annuities bring substantial social welfare benefits. And number two, individuals should convert most, if not all, of their assets to life annuities upon retirement. Nevertheless, observed rates of voluntary annuitization have remained low and in fact extremely low across the world. The inconsistency between the economic arguments and the observed rates of annuitization is known as the annuity puzzle. There are different explanations to the annuity puzzle. The first explanation is that mortality risk sharing among family members leads to a lower utility gain from annuitization, so that married couples tend to have a lower annuity demand compared to single individuals. The second explanation is that individuals are already substantially annuitized through their Social Security and/or defined benefit pensions. The third explanation is that uninsured medical expenses early in life discourage individuals from buying annuities. And the last explanation is that most people want to maintain control of their assets. Longevity annuities are devised to address the last explanation. The concept of longevity annuities was introduced by Moshe Milevsky in 2005. Longevity annuities are also known as advanced life delay annuities, or ALDA for short. A longevity annuity is a deeply deferred life annuity which begins payments very late in life, typically well after the normal retirement age. By transferring some of the risk of outliving retirement savings at very advanced ages to annuity providers, longevity annuities provide retirees with enhanced later life financial security. As payments commence at an advanced age, the cost of a longevity annuity is much lower than that of an immediate annuity, and this reduces the loss of liquidity due to annuitization. So individuals can still somewhat maintain control of their assets while enjoying retirement income security through longevity annuities. Longevity annuities were first made accessible to 401k plans in the United States in 2014. In 2018, more than 10 A-rated or better insurers in the US offered this product. With the introduction of ALDA in the 2019 Canadian federal budget, Canadians may purchase ALDA using funds from their RSP, RRIF, DPSP, PRPP, and RPP. Now I know there are lots of acronyms here. These acronyms will be explained further in later parts of this presentation. So, what are we going to do in this project? The high-level objective of this research project is to examine the impact of longevity annuity provision on retirement income planning for Canadian retirees in different socioeconomic classes. And that is done by developing a life cycle model that incorporates realistic Canadian tax rules, retirement saving plans, and demographic assumptions, with consideration of stochastic mortality and investment returns. Specifically, we would like to seek answers to a few questions. First, what is the optimal amount of savings that should be converted to longevity annuities? Second, how may saving and consumption decisions change due to the availability of longevity annuities? Third, are optimal decisions different among Canadians in different socioeconomic classes? And finally, how may factors such as asymmetric information, risk aversion, and annuity premium loading influence the utilization of longevity annuities? We will answer all of these questions using a life cycle model that is designed and calibrated specifically for Canadians. Okay, now I'm ready to give you an outline of this podcast series. In the first podcast, I will first give you a summary about the Canadian retirement income system. This is important because the life cycle model is built around the existing Canadian retirement income system. Then I will talk about longevity annuities in a greater depth. Then I will begin the discussion on the modeling of the life cycle of a typical Canadian. In the second and third podcast of this podcast series, I will then introduce stochastic mortality, explain how the life cycle model may be solved, perform simulations, and show you the results, i.e. the answers to the questions that I have previously mentioned. Now, let me do an overview of the retirement income system in Canada. In Canada, the retirement income system is composed of three pillars. Number one is Canadian Pension Plan CPP or Quebec Pension Plan QPP. Number two is OH Security or OAS for short. Number three is employer-sponsored pension plan and personal savings and investments. In what follows, I'm going to go through these three pillars one by one. CPP and QPP. The CPP operates throughout Canada, except in Quebec, where the QPP provides similar benefits. Almost every person over the age of 18 who works in Canada outside of Quebec and earns more than a basic exemption amount has to contribute to the CPP. The CPP contribution amount is determined by the basic exemption amount, pensionable earning, and contribution rate. I'm now going to explain these three parameters. The basic exemption amount in 2018 is $3,500. This means that no CPP contribution has to be made for the first $3,500 of annual income. Pensionable earning is equal to the annual earning capped at a maximum amount, which is set each January based on the increase in average wage in Canada over the past year. The maximum pensionable earning in 2018 is some $56,000. The contribution rate on the pensionable earning is 9.9% in 2018, split equally between the employer and employee. The standard time at which CPP pension payments begin is the month after the 65th birthday. However, an individual may choose to start taking CPP pension payments as early as age 60 with a reduced pension amount, or after age 65 with an increased pension amount. The CPP pension amount is determined by the number of years of CPP contributions made during employment and the amount of contributions. The CPP pension amount increases with the consumer price index, but remains unchanged when the CPI decreases. So that offers some sort of inflation protection to CPP pensioners. In calculating CPP pension amounts, periods over which the individual had relatively low or no earnings may be excluded. And this can be done through either one of these provisions. The first provision is the general dropout provision, which is available to all CPP contributors. It allows exclusion of up to 17% of the base contributory period of the lowest earnings. The second provision is child rearing provision. It allows exclusion of periods with lower earnings due to caring for a dependent child under the age of 7. Then we moved on to the second pillar, OAS. The OAS program includes OAS pension, Guaranteed Income Supplement, or GIS for short, and allowance for the survivor. It is funded by the general revenues of the Government of Canada, so there is no direct contribution to the program from individuals. In any given year, the OAS pension and GIS amounts payable to an individual depend on the individual's income in the previous year. In 2018, the maximum monthly OAS pension amount is around $590. If the annual net income in the previous year exceeds the threshold amount, which is approximately $76,000 in 2018, then a recovery tax will be deducted from the OAS pension amount at a rate of 15 cents per dollar of income above the threshold until the OAS pension amount reaches 0. Finally, we have the third pillar, employer-sponsored pension plans and personal savings and investments. Employees and employers may contribute regularly to employer-sponsored pension plans, such as group registered retirement saving pension plans, or RRSP for short, or registered pension plans, or RPP for short. The total annual contribution to RPP or RRSP is capped by 18% of the earned income in the previous year, or a flat amount which is around $26,000 in 2018, whichever is the lowest. Because contributions made to RPP and RRSP are tax deductible, these programs provide significant tax incentives for high-income earners. December 31st of the year when an individual turns 71 years old is the last day on which the individual may contribute to his RRSP. During the year when an individual turns 71 years old, his RPP and RRSP must be either withdrawn, transferred to a registered retirement income fund, RRIF, or used to purchase an annuity. Withdrawing all RPP or RRSP at once is often not the best strategy because these withdrawals are subject to income tax. However, a minimum RRIF withdrawal, the amount of which depends on the age of the retiree, must be made every year once converted. RRIF withdrawals are subject to income tax, although the earnings in a RRIF are tax-free. Likewise, annuity payments are also taxable. Another registered saving plan with tax incentives is the Tax-Free Savings Accounts Program, or TFSA for short. Canadians who are 18 or older may contribute to their TFSA at any time. Although contributions to a TFSA are not tax-deductible, the income earned from the account is generally tax-free, even when it is withdrawn. In 2018, the maximum annual TFSA contribution for an individual is $5,500. Any unused TFSA contribution room can be carried forward to future years. So we have seen a lot of features concerning different components in the Canadian retirement income system. These features will be incorporated into the life cycle model that we are about to build. Now, I'm going to talk more about longevity annuities and explain how they may fit into the retirement income system in Canada. To recap, a longevity annuity is a deeply deferred annuity that begins payments late in life. It aims to provide income security at very advanced ages and is advantageous of being less costly compared to traditional life annuities. Longevity annuities provide significant tax benefits. The tax benefits are in part due to tax deferral, which arises as annuity payments are taxed at personal income marginal tax rate only when received, and payments from longevity annuities may begin late in life. Under the 2019 Canadian Federal Budget Plan, a longevity annuity may begin payments no later than the end of the year when the annuitant reaches age 85. In addition, the calculation of minimum withdrawal from registered accounts excludes the value of assets converted to ALDA. Therefore, an ALDA purchase reduces the required minimum withdrawal from registered accounts, and this provides further tax deferral. An ALDA purchase is limited to 25% of the registered account value at the end of the previous year, and is also subject to a lifetime limit, which is indexed to inflation. All of these properties that I mentioned about longevity annuities will be incorporated into the life cycle model that we're going to build. Now, I think we're ready to talk about the life cycle model that we build for typical Canadians. The life cycle model we built is tailored for a Canadian male who turns 25 at the beginning of 2018 and lives in Ontario throughout the rest of his lifetime. In terms of notation, we use T=1 to represent year 2018, and so on. Throughout the analysis, we are going to make some assumptions. First, we assume that the individual retires at age 65, i.e. at T=41. We assume that the maximum attainable age is 100, that is, the individual cannot survive beyond T=75. And finally, we assume that the average wage and CPI remain unchanged over time, and therefore the dollar values reported in this podcast can be interpreted as real dollar values or inflation-adjusted values. The life cycle model is quite sophisticated. It involves lots of components. These components can be roughly divided into two categories. The first category are components that are related to cash inflows and outflows. And the second category are components that are related to resources and decisions. In the rest of this podcast, I will focus on the key cash flows involved in the model. Resources and decisions will be discussed in the next podcast. It is very important to distinguish between cash flows before and after retirement. Now, I wanted to focus the cash flows before retirement. These include number one, income. Well, the individual earns an annual salary of YT in year T, payable upfront at the beginning of the year. The values of YT is assumed to follow a certain deterministic function. Then we have CPP contributions. Remember, the individual and his employer contribute equally to the CPP. The contribution made by the individual and the employer, based on the description that I've given earlier, can be expressed by this formula, and we use CPPT to represent such contributions. Then we have RPP contributions. The individual's employer contributes an order 5% of the individual's annual salary into a defined contribution RPP. Next, we have RRSP contributions. We use DT to represent the contribution to RRSP by the individual. The value of DT is subject to the total contribution limit. In particular, DT cannot be greater than 0.18 minus 0.05 times YT because the individual's employer contributes 5% of the individual's pre-tax earning to the RPP, and the total annual contribution is capped by 18% of the earned income. It is important to note that the value of DT is determined dynamically by optimizing the life cycle model. Then we have the EI premium. Both the individual and his employer have to pay employment insurance EI premium every year. In 2018, the EI premium rate paid by an employee is $1.66 per $100 of insurable earning, and the maximum insurable earning is around $51,000. So the EI premium paid by the individual can be expressed by the formula given here. Next, we have housing expenses. We assume that the individual is a homeowner with a mortgage that has an outstanding term of 30 years. Before the mortgage is paid off, he is assumed to spend 30% of his annual salary on housing, including mortgage payments, property taxes, and other miscellaneous expenses. After the mortgage is paid off, this fraction is assumed to be reduced to 10%. And in our modeling work, the individual's housing expense in year T is represented by the symbol HT. Finally, we have taxes. The individual pays tax on his earnings according to federal and Ontario tax brackets and tax rates. However, his CPP contribution, RRSP contribution, and EI premium are tax deductible. Then we move on to the post-retirement cash flows. This includes number one, conversion to a longevity annuity. when the individual retires at age 65, he converts a portion of his RPP and RRSP to a longevity annuity. The longevity annuity begins to make a payment of R each year in advance when the individual reaches age 80. Then we have pension withdrawals. The individual may make RPP or RRSP withdrawals between age 65 and 70. When the individual turns age 61, the remaining RPP and RRSP assets must be converted to a RRIF. So there must be some RRIF withdrawals at a certain stage. Well, the individual converts only his remaining RPP and RRSP to a RRIF when he turns 71. Once the conversion is made, the minimum RRIF withdrawal requirements applies to the value of his RRIF. Finally, there are other post-retirement cash flows. First of all, we know that the individual will also receive CPP pension, OAS pension, and GIS each year starting age 65. And the symbols that we are going to use to represent these are PCPPT, OAST, and GIST. Finally, except GIS, all of the mentioned sources of income are taxable. All right, so these are all of the cash flows before and after retirement. In the next podcast, I will talk about the other component of the life cycle model, resources and decision. So I will see you in the next podcast.